A futures contract is a promise to buy or sell an asset at a specific price by a given date. So if you're a farmer and you need oil for your farm and you want to be able to plan your expenses out, you go, hey, it's $50 a barrel now. I'm going to buy it now at $50 a barrel. So whoever's on the other side of the contract will deliver me oil at $50 a barrel, even if oil goes up to $100. So I save money on that. Or if it goes down to $25, I still have to buy it for 50, and the other person makes money. But I'm okay because I have a fixed price for. I could plan for the price what my oil would be. In the crypto space, the futures contract is not like in the vast majority of circumstances isn't you're not going to get delivered the actual crypto at the end. It's cash settled. So you're making a bet directionally that, hey, I think in 6 months Cardano will be lower than it is now, and so I'm going to sell it now, and when it goes lower, I'll be able to buy it back. It's basically like spot, but futures. Something happened in the future, and then you also get to leverage it. But for perpetual futures, which is a type of futures contract that only exists within the crypto space, it's like you get all the benefits of the leverage of the asset, but it never actually expires. So you never actually have to deliver it, which means you could hold this perpetual futures contract indefinitely. Plus, there's a funding mechanism where, because you wouldn't want the futures price on a perpetual futures contract to get so far out of whack from the underlying spot price. It would just be crazy and be untradeable. And so, it's like, what are you trading at that point? Some other asset doesn't even exist. And so, there's a funding mechanism that, as it goes up or down, the people on the other side of that trade have to pay, like whoever's the futures contract, you have to borrow the asset to be able to short the future. And so, you have to pay this funding fee in order to hold that position. So, as the price gets further and further away from the spot price, the funding increases for whatever side is against that price move. There's an impetus to like sell off that asset or to close your position in order to not eaten out by that funding rate. Anyways, I'm trying to make this short. The standards futures contract does have an expiration, and so there's this incentive to, well, necessity to close your position before the expiry, which causes all these sort of movements within the futures contract. It also allows institutions to hedge positions that they're in. So let's say some institution has a $1 million worth of ADA, and they're going to want to sell that ADA in 6 months because of whatever strategy they had. They know they're going to sell this ADA in 6 months. And so what they could do is take the 6 months contract and sell it now. They've basically hedged their position.